Welcome to our deep dive into two indispensable financial metrics, the debt-to-equity ratio and the interest coverage ratio. In today's dynamic business environment, understanding a company's financial health is paramount, not just for investors and lenders, but for business owners and managers themselves. These ratios provide critical insights into a company's financial leverage, solvency, and its capacity to meet its debt obligations. They are the bedrock of effective debt management and play a crucial role in assessing risk and opportunity. By the end of this session, you'll have a clear grasp of how these metrics are calculated, what they signify, and why they are absolutely essential for making informed financial decisions and driving sustainable growth for any enterprise. Let's begin our exploration into how these powerful tools can illuminate a company's true financial standing. Let's first unravel the debt-to-equity, or DE ratio. This fundamental metric sheds light on a company's financial leverage by comparing its total liabilities to its shareholder equity. Essentially, it tells us how much of the company's assets are financed by debt versus what's financed by owner's capital. The calculation is straightforward. Total debt divided by shareholder equity. A company with a high DE ratio is relying heavily on borrowed funds, which means it carries greater financial risk. This reliance often stems from a strategy to grow rapidly without diluting existing ownership, but it introduces significant vulnerability, especially during economic downturns or periods of rising interest rates. Understanding this ratio is vital for assessing the balance sheet structure. Interpreting the debt-to-equity ratio requires nuance, as what constitutes a good or bad ratio varies significantly by industry. For instance, capital-intensive industries like manufacturing or utilities typically have higher DE ratios because they require substantial long-term investments in assets, often financed through debt. A DE ratio of 2.0 might be acceptable in utilities, but alarming in a tech startup. Conversely, service-oriented businesses often maintain lower ratios, perhaps below 0.5. A high ratio, let's say 2.5, signals that a company is funding a significant portion of its growth through debt. While this can magnify returns during boom times, it also amplifies losses when performance falters, making the company more vulnerable to interest rate hikes and economic downturns. It also negatively impacts creditworthiness.